All right. Good morning, good afternoon, traders. Today is Friday, June 13th, Friday the 13th, 2025. This is You've Got Options for Income Navigator. Today, we're going to talk about a strategy. I'm not sure if we have covered this before, but if not, awesome. If we did, maybe this is going to be a refresher. We are going to talk about covered strangles and a slight variation of a covered strangle. We're going to look at a few different ways we could kind of achieve the same. And we'll also talk about, the benefits and some of the takebacks about this strategy. And, hopefully I will get you guys to think about not just the strategy, but how we can use synthetic strategies to replicate other strategies using options, right? Options give us a lot of flexibility. Whereas, when you're just trading stocks, you're either long, right? You make money when the underlying goes up, or you're short. You make money when the underlying falls, and there's really nothing in between. Options, give us a whole bunch of different other potential strategies that we can use. So let's dive in here. So what you see on my screen, right? This is a covered strangle that I have on for 178 days. And if you wanted to take a look at this trade, I do have it posted on Discord. I think I need to update the trade ID. This trade started off with a short put. I was willing to take assignment, and I got assigned 500 shares of TLT. And then I started to sell strangles around long stock position, which is what made it a covered strangle. What makes it a covered strangle is that once you long stock and you sell calls, this is a covered call position. So, right, so this the short calls are no longer naked; they're covered, right? So the risk isn't unlimited to the upside. As a matter of fact, our risk to the upside is capped, right? Because if we get called away at the short call strike, we have stock to deliver. So there is no upside risk. The only quote unquote risk in this trade is if the underlying goes lower, we have to decide to buy more share at lower prices, but all of that has to be thought about and planned for before we go ahead and sell the strangle, right? So if you bought initial tranche of stock and you, for whatever reason, don't want to buy any more shares, then maybe covered strangle isn't the best trade to do. Maybe just look to do covered calls until you get called away, and then you can sell puts again to potentially get assigned. But if you're going to break up this trade in several tranches, for example, if you wanted to initiate a trade today in TLT with the underlying trading at around 85, maybe you sell a 82 put, and that's your kind of first level where you would like to get long. And then you say, all right, if I get long at 83, I'm going to probably buy more at 80. So you can sell covered calls against stock that you get assigned at 83, and then you sell an out of the money call against your shares, and you sell another round of puts looking to potentially buy more stock at lower prices, right? So in this scenario, you have long shares and you kind of want to have a good reason to own shares. Maybe you like the underlying long term, right? I wouldn't do this on a stock that is a high flyer. This is what the latest and the greatest on social media. Everybody's talking about, and then 2 weeks later, no one cares. You don't want to trade any kind of covered strangles around stocks that you wouldn't want to own for the long run. Maybe it's something that you wouldn't mind owning in your retirement account, or maybe you just like the underlying because you think that 5 years from now they're going to be much bigger than they are today. With TLT, there is a great reason to own it because even though if you look at the price chart, yeah, it has its moments where it goes up and then it could come down quite a bit. Even, a 15-point move from 85, right? It doesn't sound like a lot, but if you take 85, 15 out of 85, that's a 17% move to the upside, and then from 100 down to about 90 or 88, that's a 10% move to the downside. So you may think there's a lot of volatility, but these are long-term bonds. These are 20, 30-year bonds. Sure, there are times when volatility is high, but while you wait for this volatility to do whatever it's going to do, TLT right now pays over a 4% dividend. So, while you're holding on to it, you could be selling covered calls to generate more income, or, you can consider that as potential reduction in your cost basis. So you get the dividends, you get income from covered calls, and then if you are going to layer into this trade, selling puts could potentially improve your cost basis even further because, if the underlying starts to pull back and you sell several tranches of the cash secured puts, you will eventually dollar cost average into a better position, right? So this is what a covered strangle looks like. You're long stock and then you're short a strangle around that stock. No upside risk. The only risk is having to own more shares at lower prices, and you have to commit to it. Now, so you get three incomes here, right? You get the short puts income, you get the short call income, and you get the dividend. And then potential bonus is at some point in the future, if you get called away, if your shares get called away, you get the capital appreciation. That's your potential fourth source of income in this trade. Now, that's all great, right? But to own shares, right, you have to come up with quite a bit of capital. In some cases, if you're trading a higher priced underlying asset, for example, let's see, one that comes to mind is, let's say, Netflix, right? I'm not saying that you need to trade Netflix for a covered call, but to buy 100 shares of Netflix. Netflix is currently at about 1,200, right? So to buy 100 shares, you need $120,000, and that's just to buy 100 shares in order to be able to write one covered call, right? So that will potentially tie up a lot of capital. As an alternative, right, what we sometimes look to do is we look to use leaps, right? We'll look to use leaps to replace long stock position. We go in the money, deep in the money, leaps, and then we'll sell a shorter term call against that leap, and that will replicate a covered call, except you don't have to come in with, in the example of Netflix, right, where 100 shares you have to put up $120,000, you may have to put up a fraction of that, right? Maybe only 20%, and we can take a look just to see what that would look like, right? So, for example, we have Netflix here, and if we were to buy 100 shares, we have to come up with 120,000. Now, if we were to replace the 100 shares with, bear with me, I'm going to scroll and try to find something with 365 days or more. So 370, which is June of next year, right? And then we go in the money. So we'll look for maybe an 80 delta call, right? So 80 delta call would be equivalent to owning 80 shares of Netflix, right? It's not quite 100 delta where, for every 1 point move, you make $100 as if you already own the stock. Buying an 80 delta call will give you exposure similar to owning 80 shares. So the stock is currently trading at 1,200. If we were to buy a call that's about $300 in the money, right? This call you can see is going for, let's call this $400. 400 times 100, right? That's $40,000. So to buy one 900 call, right, it would take $40,000 versus buying 100 shares of stock, which will take $120,000. So it's not anywhere close to $120,000. It's only a third of that, right? So you could potentially use your capital a lot more efficiently. So that's one way to do it, right? If you buy the leap, right, you're paying $400, 300 of which is intrinsic, and about $102 is extrinsic value, right? So there's still some extrinsic value to lose. But decay is going to happen very slowly since this one has a year until expiration. And then while you're holding on to the leap that's in the money and 1 year out, you can use shorter term options, maybe 30 days, maybe 45 days, maybe 60 days, whatever makes most sense to you. And you can look to sell covered calls against it. So if you were to buy the 900 call in Netflix and then sell maybe, let's see what's out of the money. And you can use Delta, right? I think that makes a lot of sense, going by Delta. Or you can look at a chart and say, I don't think that, Netflix will pass through certain resistance level. Clearly, I think Netflix is at an all-time high right now. So there isn't much resistance above 1270. So you can say, you know what, maybe 1300 is the first line in the sand. I'm going to sell 1300 call. You have to be bullish, right? You have to be bullish. And as you can see, you're getting exposure of about 45, or you can round this off to about 50, right? Delta 50 tells us that this is equivalent to being long 50 shares of Netflix, right? So, and instead of coming up with $120,000, this only takes up about $37,000 to do it, right? So much lower capital requirement. Now, if you wanted to, right, and we can stay with Netflix for this example. I know that I think John asked about something similar with Apple, and I'm going to get off this Netflix example right after this, and we'll look at Apple, and I'll show you a couple of other variations that I would consider. And what I want you guys to pay attention to most is the shape of the risk graph, right? And I'll tell you why in a second. So this is very similar, right, to a covered call, right? Except as you can see, if we let this one run too far, and it's not a big risk if our short call goes in the money, but at some point, well, not in this case, but if we were to sell, for example, instead of 1300, if we were to sell maybe an at the money call, right? You can see that if you let this one get too far away or too far in the money, it's not a big deal. You still will potentially make money, but as you can see, our long delta, right, our bullish exposure, it starts to fade as the stock starts to rally. And at about 1400 level, our delta goes to pretty much neutral. It's not a bad thing, right? If the underlying runs up to 1400 and then sellers come in, that's like the best case scenario for this trade. But if at 1400 this one finds more fuel and buyers are just piling in, right? You're no longer benefiting from any further upside because you don't have any positive delta. As a matter of fact, right, your leap isn't going to bring in enough profit to offset losses from this deep in the money short call. And you can see this in the risk graph. So in my opinion, I mean, you can hold it, right? But at the same time, the way I think about it, it's not wrong, right? It's not a terrible thing to do to hold it and wait for all of the extrinsic value to disappear in the money short call. But if I'm going to hold on to this, you still have, $35,000 of risk on the line, right? Odds are Netflix is not going to zero, but yes, you are tying up about $35,000. And if the stock is going higher and you're not really getting any benefit, you need to change something about it, right? You can potentially look to roll your in the money short call up and out, right? As long as you can do it for a credit, it's not a terrible thing. you will regain positive delta and you can continue to stay in the trade. Or maybe you can say, you know what, this is going to now become sort of a counter trend play. At some point, the underlying is going to pull back, and yes, you will potentially get the benefit, right? So there's no right and wrong. I don't think there's the right way to think about it is that there's one right way and everything else is wrong way. You just have to understand where you are on this risk graph, and based on right the shape of this graph, if the underlying continues higher, don't be surprised that your position isn't making money and actually could be showing a small loss, right? And if you think that we reached, we ran to about 1400, maybe 1450, and now you're expecting some sort of a consolidation or a pullback, right? Any downward movement is actually going to play into your hand, right? So you just kind of want to know where you are on the risk graph, and you could expect your P&L to be either positive or negative based on the shape of your risk graph. Hopefully this makes sense, guys. And then if you really wanted to go one step further, now you are in a poor man's covered call, which is also a call diagonal spread. And then if you wanted to, bringing a little bit more income, you say, you know what, I would be possibly willing to buy more shares at maybe 1100. Right, so this is kind of a backdoor covered, poor man's covered strangle, right? You don't own the stock, you own the leap, and then you're short an at the money call and out of the money put. You don't have to do an at the money call. You can go out of the money. You can move these strikes around to whatever makes most sense to you. The only thing is what you really want to think about is that if the underlying goes under the strike of your short put, right, at 1100 times 100, right? You got to have $110,000 to take assignment of the shares. Or what you can do is you can possibly get out of that position and replace your long position at 1100 with another in the money leap and so on. Right? So long stock can be replaced with a deep in the money long call option. Now, what I want to talk about is other ways, right, to build something similar. And we're going to look at Apple, right? So we just talked about replacing stock, and Apple is not, as high of a price stock as Netflix. So 196 is where Apple is trading right now. With buying 100 shares at 196, you still have to put up, almost $20,000. You can possibly look at, going for a leap, 365 days or more out in time, and then go to about maybe 80 delta to buy that leap. It's going to cost you way less than $20,000. Or what you can do, right? And I want you to, and if you're newer to options, this might go, over your head a little bit, but don't freak out. But let me show you what first of all, a covered call. This is what the risk graph of a covered call looks like, right? Let's just use August 15th with 63 days. Doesn't really make a difference, but let's say we bought 100 shares and we sold one call against those 100 shares. And this is what the risk graph would look like, right? We go up and then we potentially give up all of our upside above 210 because that's where we sold our call. So for this trade, you would need to pay for the stock. You come up with $19,600, and then you get about $500 worth of relief. So you have to come up with about let's just call this $19,100 to put this trade on, right? You can replace your long stock position with a leap. right? So let's see, June 18th of next year. Let's go with um, an 85 or right 85 delta. So it's a 135 call, right? We'll buy that. Similar looking risk graph, except right with a traditional covered call, right? Any more gains above 210, our risk graph at expiration was flat. Here, right, you can see that the higher it goes, we actually may be losing money because your short call is now deep in the money, but your leap isn't covering it because there's still a lot of time until expiration, which means there's still a chance for this leap to, expire out of the money. So they're not moving one for one, right? They're not moving one for one. So your leap will actually stop gaining delta while your short call will continue to accumulate short delta. You will end up with a net negative delta somewhere around 260. Right, but there's still no risk. There's no risk to the upside. You just won't make as much unless, right, you're expiring on the short call somewhere very close to um, where you're at the strike price where you're selling this call, right? The best case scenario is for the underlying to be smack in the middle or right at the strike where you're selling this call, right? Which is 210, right? But 215, you can see that you're going to make a little bit less. At 220, you'll make a little bit less. And then the farther out of the money or the farther deeper in the money you go on the short call, right? Your P&L is going to be reduced. So, not a terrible trade. And you can also, just like we looked at with the Netflix example, you can also add a a short put, cash secured. Maybe you're saying, you know what, I replaced the first quote unquote 100 shares with a leap, right? The second 100 shares I may buy at 175. Or again, if you're about to get assigned on this 175, you can close it out and replace this 175 with another leap, and that should put you in a very similar position. Um, you can see that doing a poor man's covered call, right? This will only tie up about $6,600. Whereas if you had bought 100 shares and sold it to 10, you needed $19,100. Right? So you're getting about 3-to-1 leverage. You only have to put up 1/3 of the capital needed, right? To do a poor man's covered call compared to buying shares outright and selling a call against it. So I don't think it's a terrible idea to do it with Apple because, what is the benefit of owning shares of Apple? Now, if there's a special dividend or if there's something along those lines coming up, you're not going to get it with the leap. I don't think Apple pays a high dividend. Apple's dividend is a half of 1%. So there's really no sense of, you may like the stock long run, right? For the long run, great. But there's no incentive, so to speak, right? To buy shares and hold shares. I would probably look to replace shares with the leap because again, you're going to use your capital a lot more efficiently that way. So now the reason why I wanted you guys to pay attention to the risk graph and right is because there is another way to do it, and I showed this earlier in the Discord. Another way to replace a covered call strategy, right? Long stock, short call is equivalent to being short in the money put. Let's say we are going to use the same 63 days until expiration. We talked about 210. If I sold it 210 put, does this look similar to a covered call strategy where we're long stock and short 100, we're long 100 shares and short one call against those shares at 210, the risk graph is identical. And what do you have to put up for this? If we were to buy 100 shares and sell a 210 call, remember, you would have to put up $19,100. But to sell a 210 in the money put, you probably have to come up. Well, this software is showing about $4,000. You can look at your broker platform to see what it would cost you and buying power to sell a 210 put in Apple at August 15th expiration cycle. I'm going to double check to see. But if you have this on Tasty, I'm looking on Thinkorswim. So let's see. If I was to go out and sell an August 15 210 put, 210 put for about $17, I would collect $1,700 in premium, and my margin requirement is about $2,600. Right, so nowhere near $19,100. And the risk graph is identical, which means we collected $1,700, right? It's currently going for about 17 and change. That's our max potential profit. And this is an equivalent, an identical position to being long 100 shares and short 210 call, right? So this is a lot more margin efficient, right? Selling an in the money put will take up way less capital, and you get the exact same benefit if you were to buy 100 shares and sell a call against it. Does this make sense, guys? I hope you guys can see this, and I hope this is clicking a little bit. Right? So we're using an in the money short put to replace a long stock in the short call position. The only risk here is, right, we're selling right now, let's say a 210 put that is in the money, but there's still $3.70 of extrinsic value in this put. That means that getting an early assignment is very unlikely, right? We don't really want to sell options in the money because you could get assigned early and then you have to deal with it. But as long as there's extrinsic value, you don't have to worry about getting assigned. And then if the underlying is going to go down, right, you are exposed essentially to the same exact delta as if you were long stock and short a call, right? You can decide what to do, because if the underlying goes down and you may, if this put goes deep in the money, you have to just keep one eye on the extrinsic value of this in the money put, because if the extrinsic value disappears within, last couple of days before expiration, yes, there is a chance you may get assigned, right? You're going to be assigned stock at 210. 210 minus 17 that you're collecting for this short put, right? We take 210 minus 17, your cost base is going to be somewhere around 193. Now, if you get put stock at 210, your true cost is 193. Maybe you can sell a 195 call against those shares and get your way out of this position. Right? So that's one way to do it. But this is a synthetic covered call by just selling one in the money put. Now, if you want to go one step further and say, you know what, I want it to a covered strangle, a poor man's covered strangle, right? So this is a poor man's covered call. And this is, I think this is truer, or this is more of a poor man's covered call than buying the leap and selling a call. Just one in the money put will give you a true covered call risk graph. And then you can add another short put. Maybe you say, you know what? I want that risk graph of a covered strangle So maybe I'll sell one more at 175 level. And this is a risk graph of a covered strangle. Now, the risk here is that if the underlying goes down below 175, right, you have to buy shares at 210, and then you could potentially have to buy more shares at 175. So even though you may only, right, if I did that and I added also a short 175 put, so now my margin, and this is in a portfolio margin account, so Reg T is probably higher, but my margin is only about $3,700 here for selling 210 and a 175 put to put me in a synthetic covered strangle position. But the reality is, if I am going to let these options go deep in the money and I'm facing an assignment, I need to have the capital to get assigned 100 shares at 210, right? Which is what? $21,000. And then potentially another 100 shares to be assigned at 175. So that's another $17,500. So I would have to have, if I plan on taking assignment on both tranches, I would have to have $38,500 set aside, willing to take the stock. Or I can, you know, look to roll these puts out for as long as I can collect the credit. I don't want to pay a debit. I don't want to extend the duration of my trade, right? That means I'm taking risk for longer without any benefit in return. I don't want to roll and pay a debit. If I can roll and collect the credit, that's great, right? If I can roll and maybe do it for break even just to kind of buy a little bit of time for no cost, just to see if the underlying is going to bounce, right? But you can't really, or you shouldn't, right? Look for someone else to blame if you put on this position and the underlying goes down. Why? Because to start, right, this is a bullish position. You have to be bullish. So like if you put this position on and the underlying goes way down, well, it's nobody's fault but yours because you chose to put on a net long delta position. And if the underlying goes down, well, you can try to figure out what to do with it. If getting assigned shares was never the plan, you need to have a plan for what are you going to do if the underlying goes, let's say, to 190, right? Your 210 is now getting deeper and deeper in the money. What are you going to do? Are you going to roll it? Are you going to hold it? Are you going to get assigned, right? You have to know what are you going to do with 210? What if the underlying goes to 180? Your 210 is even deeper in the money, and now you're approaching that 175 level that you need to know what are you going to do if it continues to go down, right? So all of these things, you don't want to start to think about these things as it is happening, right? You don't want to make decisions on the fly because there's going to be some emotions involved, and you're probably going to make all the wrong decisions if you let emotions drive your decision making process, right? So you kind of want to think about all of these things beforehand, right? You know what your risk graph looks like. You know where you're going to make money. You know where you're going to lose money. If you do take assignment on 210 and decide to roll 175, great. As long as you're keeping track and you know your true cost, right? Because then once you get assigned on any part of this trade, you can sell a call against it and continue to stay in a similar position. And by selling calls, you're possibly lowering your cost basis. And then as long as you're selling calls above your cost basis, assuming you're right and the underlying is a good hold longer term, eventually you get called out of your position and you will realize a capital gain. But in the meantime, those covered calls are going to generate some income that's going to go to reduce your cost basis. Right. So this is another way to do it. Way, way cheaper than buying stock, selling a covered call, and selling another put. Right. This is a synthetic or poor man's covered strangle. Right. And you're replacing a covered call with an in the money short put, and then you're adding another short put out of the money. So in this case, you would collect about $1,700 for the 210 short put and another $300. So you would collect a total of about $2,100, and you have to put up, um, about, let's just round this off to about $4,000 in a portfolio margin account. And if you're right and the underlying goes higher, these options will expire worthless. You get to keep the premium. And the reason I say this, John, I'm speaking to you now because, when you asked that, aren't I, or am I not going to make, let me just see, I forget what the question was. You said, don't you also get the profit from the long leap? We don't really need to get the profit from the long leap because the risk graph here is exactly the same, right? If you instead of doing an in the money short put, if you did a leap with a short call, yes, you will make money with the long leap, but you will lose some of that profit with a short call. Here, by selling an in the money put, right? If the underlying is going higher, the value of this put is decreasing. Since you're short this put, that is a gain to you. So the profit and loss would be almost identical. I actually will go out and say that you will make more with a in the money short put than you would with a leap and a short call. Because remember, a leap and the short call, all right, here come the crayons. Bear with me, guys. Right? Leap and a short call would look something like this, right? Whereas a short in the money put, a short in the money put is this and this, right? So with the short in the money put, you actually gain all of this if the underlying is going to actually move where you think it's going to go to begin with, right? So with a leap and the short call, once your short call goes in the money, you will have your P&L slightly reduced at expiration, right? Because losses on the short call will slightly exceed the gains from the leap. But if you are in a synthetic short call position, you don't care how high the underlying is going to run, right? Because the higher it goes, the faster this 210 short put is going to decay. All right. Hopefully that makes sense. But the reason why I'm doing all of this, guys, is to show you what the risk graphs look like. And if you, again, I highly, highly recommend that everyone use, if you have Thinkorswim, they have a great analytical tools. I'm not sure if you can do the same with Tasty, because sometimes when you use options in different expiration cycles, the way their risk graph shows up is a little weird. But in any case, use whatever tools you have available. There are other, third-party softwares that can give you the same, or Option Explorer does a good job. But you have to visualize and you have to compare, right? What would my risk graph look like if I did, a leap in the short call? What would it look like if I did an in the money put? And you will quickly notice, right, a difference in the risk graph. You also want to pay attention to your T plus zero line, right, which will eventually morph into the risk graph at expiration line. So you can find, and then you compare, what would it take? How much money would it take to put on one position? How much money would it take to put on a different position, synthetic position, right? The stock replacement position. And then you figure out, right, which strategy has the best use of your capital. Like, I'm not here to make the case that this is the number one best, but if we're just comparing apples to apples, if I was to put this on with long 100 shares, short and out of the money call, and short and out of the money put, doing this trade will give you the exact same risk graph, but it will take up a lot less capital. Now, just because it takes a lot less capital doesn't mean that you need to 3x your size, because you have to be aware that, this is a 91 delta position, which means that, this is equivalent to owning 91 shares of Apple. And then as Apple goes down, you can see that this delta is going to actually increase, right? So the lower it goes, the more directional exposure you get. So you have to kind of say, all right, if just because it takes up very little capital to get into this position, if I 3x my size here just because, the entry is so low, what would it feel like to own 270 shares and Apple goes down 10 points? Right? You do the math, you figure out what the expected P&L is going to be like. If that's too much, then obviously this trade would be too big at 3x. Right? Hopefully that makes sense. So you don't size your trade based on how little capital it takes. Look at your delta, right? How much will you be up or down if Apple moves 10 points, right? You have to be comfortable with those numbers. Size that trade. So for example, if let's say Apple, maybe and again, this is just an example, right? But if we break 195, Apple is probably going to get weaker, right? We have like this reversal candle. What was the low? The low there was 189. So between 195 and 190 is kind of like your make it or break it. Maybe, right? I don't know. It depends how fast we get there and what's happening in the market. If the world's coming apart and then these 95 and 190 levels mean absolutely nothing, right? Because Apple is one of the biggest market caps out there, and when institutional investors need liquidity, they'll sell whatever they can and they don't ask questions. So Apple is going to get sold, not because it's a bad company, but because there's a great demand for liquidity and Apple is getting sold and you cannot do anything about it. But if the market is just kind of drifting and we're going nowhere, maybe 195, 190, maybe 190 is your line in the sand. And, if we get to 190, maybe you say, what, I'll give it a couple of extra points. Maybe it's 187. So at 187, you're down about $1,000. If that is within your max allowable loss per one trade, then you say, all right, we get to 187, or at any given time, if I'm down $1,000, I'm out. So what is my risk to reward here? Maybe you're willing to risk up to $1,000 in this trade, right? Up to $1,000. This will push your stop to about 185 level, 186 maybe, right? So if you're wrong on being bullish, you're down 1,000, you get out, it's a loss. But if you're right, you'll make about 2,100. So you're risking one to make two. It's not a terrible plan, right? But the key here is when you get to $1,000 loss, don't try to convince yourself why, Apple should be trading higher. The market doesn't care. You need to ask yourself if you want to be right or you want to make money, right? So clearly, putting on this trade at 196, now with the stock at 186, hello, you're down 10 points from where you started. The market, the price is clearly telling you something, right? You need to recognize that early on and don't fight it. Don't try to renegotiate. Just follow your plan. All right, let's have a look at some questions, guys. Hang on, I'm going to scroll up. I'm having a problem wrapping my hand around the idea of selling an in-the-money put, which can be exercised at any time. Seems like I would be increasing the management effort. So yeah, if you sell an in-the-money put, right? This is an in-the-money put, and this is what it looks like. If you sell an in-the-money put, you also want to take a look at what the extrinsic value of this put is. It doesn't make any sense for whoever is holding this put. Maybe it's somebody with long shares and they bought this put for protection and now this put is in the money. Like if they exercise this put and put the stock to you, they will be giving up the $366 of extrinsic value. Right? The intrinsic value they will be giving up. So it's actually for your benefit because you can turn around if you get put stock, right? You will have kept the premium that you collected for the short put, you can turn around and cover your shares, and um, you will make this time premium, this extrinsic value. So the odds, I know that, in the retail trading world, you hear a lot about, oh my God, your option is in the money, you're going to get assigned. It doesn't work that way unless it makes economical sense for whoever's on the other side of that trade to assign or to exercise their option to get you assigned. It doesn't make sense for them because they would be losing money. Sure, there may be a fat finger, or there may be some inexperienced trader who, bought shares at maybe 220. They bought a protective put at 210. Now the stock is at 190, right? They're freaking out about it. They have no clue about how much extrinsic value left in that put. They may hit the button to exercise and you get chosen, right, to get that stock put to you, but it actually works in your favor. So I wouldn't worry too much about it unless, right, there is a dividend payment coming up in Apple, and I think they pay like 26 cents or something like this. So if the extrinsic value in the money put is less than the value of the dividend that they're about to pay out, there is no reason for the other side to exercise this put. As long as the extrinsic value is greater than the dividend payment that's coming up, there is no reason why the other side of this trade has to exercise this option, and your chances of getting assigned early actually are not that great. And if you do get assigned, right? If you do get assigned, you turn around, you can cover your shares, or if you get assigned, now you're plus 100 delta. You can turn around and sell 2 at the money calls, right? Long stock, 100 delta, selling 2 at the money calls. At the money calls at delta 50, you will turn around and just neutralize your position. Like there's ways to, right? And you will collect the premium from at the money calls you're selling against your long stock, right? So you will actually reduce your cost basis, right? From 210, if you collect $17, right? That gets your cost to 193. If you turn around and sell 2 at the money calls, maybe they're trading for about $1,000 each, right? So you get your cost basis down to like 170 something. So it's not that, it's not that big of a deal. If you're not comfortable, and I know that, you said you can't wrap your head around it because, if you don't think about it enough, then yeah, it sounds like a super complicated topic. But if you really think about it, and I would, I would say, you can probably simulate this by saying, all right, let's assume that I already sold a 210 put and now I got assigned last week, Friday. So now I am long 210, or I'm long stock at 210, but my cost basis is not 210, it's actually 193. And then you input that into your platform to see what that risk graph looks like. And then you can say, all right, if that happened to me, what can I do? Can I sell a covered call against it? Yes. What would that risk graph look like? Can I just, you can sell stock against it, or sorry, you can sell calls against it. You can probably buy a put, maybe, right? Let's say, if you get assigned, stock is at 196, right? You get assigned at 210, your cost is 192 or 193. Maybe you can buy a put to cut off your downside risk. Yes, that's going to cut into your potential profit, right? Because you're now paying for protection on the downside, but that should give you, the peace of mind I think you're looking for. If you're using leaps and short calls, that's great. But I think that if I needed to do a covered call replacement and I didn't want to put up the capital, again, we looked at it a little bit earlier. where you can just, again, the best advice I can give you is go ahead and model two trades, look at the buying power requirement for each, compare the risk graphs, because they're going to be very, very similar, except in the money short put takes less capital to get involved. Let's see. John is saying, isn't this true? If I hold it until expiration, I tend to take profit at um, this. I mean, I'm not sure what was this question for, but if you're saying if maybe you're asking if you sell an in the money put, would you take profits at 50%? Maybe, right? Why not? If you get to about from 1,700, maybe if you're up 700 or $600, right, somewhere here, if you can make a $700 profit or maybe $850 profit, and it only took you about $3,600 to get involved, right? It's a great rate of return on margin. Now that margin might fluctuate, right? So it's not really like, let me go all in because, this is a great reward on margin. But, you know, if you decide to take profits at 50%, the monies that you put to secure this trade has earned about a 23% return, which is not so bad. Let's see, one more question. I've been following Tom's current poor man's covered call approach in which we wait to get all of the extrinsic value out, usually holding to the afternoon of expiry. Does using a short put change that idea of holding until? No, I don't think so. I think that this is exactly the same because if you were, let's say, the only time you actually want to do something about it. So like if this is what your risk graph looks like on the day of expiration, and it's gonna actually look, you know what, let's go and do something different. Let's look at options that expire maybe next week. Right, so this is 7 days until expiration. We're gonna look at the same 210, which now has only 2 cents of time premium. So getting assigned on deep in the money put, right? Once this time premium starts to run and closer to zero, the odds of getting assigned are starting to increase. So I probably, again, this is not to say that, if you're following Tom's trade and it's working for you, by all means, right? You do what's best for you. We're just, having a conversation, comparing different approaches to this, right? Like I wouldn't wait for the day of expiration. This 210 is worth, right? All of this, $13.80, 13.80. This is all intrinsic value. There's no extrinsic. There's 2 cents of extrinsic value left. There's no reason to continue to stay in this position, and there's a week to go. So I would be looking to potentially, maybe getting out of this 210 here for 13.80 and selling, maybe another put at 14 and a quarter or whatever, right? As long as I'm collecting a credit. Like I wouldn't go deeper in the money unless you're now becoming more bullish, right? You can go deeper in the money, but you can see that, how much time premium are you capturing over the next 20 days? If you go deeper in the money, there's very little to no extrinsic value. So I would probably go for, if I roll just sideways from 210 with 7 days to 210 for 20 days, right? I collect 50-cent credit and that's all time premium. Not a bad deal. I mean, if you're maintaining the same outlook, why not? But I think that to answer your question, you don't have to. If you're going to do an in the money short put, you don't have to wait until last day on expiration date to make an adjustment. You just want to keep an eye on your time premium, how much time premium is left in that in the money put, and if you can get a chance to roll to capture a little bit more time premium, then that's a good deal. If you can't, then you have to probably go out a little bit further in time. Instead of going for 20 days, you look at, all right, if I roll from 210 to 210, right, instead of 20 days, I go 28 days, there's 82 cents of extrinsic value, and so on. If you go even further and you look at 210 with 35 days, there's $1.37 of time premium. So, you definitely have options, pun intended. Um, yeah, so hopefully, this kind of gets you to think a little bit. And again, I know that, it may sound scary, and we actually have a post on Discord about, why do retail traders try to stay clear of, in the money options. And, we talked about a few different reasons why, but in reality, it's not as scary as it may sound. Let's see if there is anything else. That was back when you were analyzing. Yes, synthetic leap. I think I already answered that question. Um, John is saying, so this model is about stop loss and profit, not getting intrinsic. Like you can see how much extrinsic or intrinsic, or you can actually do the math and figure it out. How much time premium is left in any of these options. Well, there's only one option here. If you're going to use an in the money short put, you're only using one option. You can figure out, how deep in the money is it? That's your intrinsic. And what is this option worth? Well, in the software, I can, look at what time premium is left in this option. So if I was short 210, maybe my risk graph wouldn't look as great because let's say maybe if I put this on, I don't know, last week when Apple was at 202, now it's at 196, I probably got less credit than, this is a really good looking risk graph. But at any given time, you can look at the mid price of your option. You can figure out how deep in the money it is. That's your intrinsic, and subtract your intrinsic from the price of an option, and that'll tell you how much extrinsic value you have, right? Because an option premium is made of intrinsic, if there's any, and extrinsic. So if an option is out of the money, there is no intrinsic. All of the value of that option is extrinsic. That's time premium. If your option is in the money, now it has intrinsic value, which is the difference between the strike price and the current price of the underlying asset. That's your intrinsic, and everything beyond that is your extrinsic value. Right? So you can figure out how much extrinsic you have left. So if I was let's say if I was in this position with 7 days to go, I would say, all right, what do I have? I have a nickel of time premium. Like, am I going to hold this for another week to earn 5 cents? No, right? I'm going to roll. I don't want, and by rolling out in time, increasing my time premium in the option, I decrease the odds of me getting assigned on this in the money put, right? So it's kind of a defensive play. But all in all, looking at the risk graph, you can kind of figure out, right? If the underlying was to move down 10 points in 2 weeks, what would I expect my P&L to look like? Right? If I'm not comfortable with that dollar number, I either need to reduce the size or I need to use a stop before we get to that number that makes me feel uncomfortable. Right? You can size your trades based on some kind of price levels, right? Like we talked about earlier. If let's say 190 is your line in the sand, we get to 190, I'm going to lose $1,000. Okay, that's within, for example, it's within my max allowable loss per one trade because $1,000 loss will represent maybe a small fraction of my overall account. So I'm okay with it and I can size the trade accordingly. But if my max allowable loss for any given trade is, let's say, $250, and at 190, I'm going to be down $1,000. Well, that way exceeds my max allowable loss per trade. That means I need to either reduce size or use a stop loss, before we get to that $1,000 loss. If let's say I put this trade on and my max allowable loss per trade is maybe $200, let's go back to the August 15 to 10, right? If I put this on and my loss, my max allowable loss per trade is maybe 200 and, or maybe it's $300, right? Somewhere here. And I go all the way to the left, right? Where am I down $350? Somewhere around 192, which means that I can hold the stock, but if it goes from 196.50 down to about 192.80 or whatever the case, whenever this trade is down $300, I got to be out. Right? So I'll do a one lot and my stop is maybe 193. Right? So you can look at some price levels, figure out what your P&L is going to look like and size your trade accordingly. All right. So I think we covered most what I wanted to talk about. Yes, this is recorded, so I'm going to post this a little bit later today. Hopefully, you got something out of it. Hopefully, I got you to think about these synthetic replacement strategies. And again, just if you know your risk graph, you can figure out a way to model your position or to build a position using options, right? You don't have to be long stock and short call. You can just go in the money, sell a put. This will give you exact same risk graph as a traditional covered call. But unless you practice, unless you do this time and time again, it's really hard to understand. And I don't think there's enough information out there, that will break it down and explain these kind of things to you in detail. So that's why we're here. All right, I'm gonna run, guys. Thank you all for coming out and taking the time. Enjoy the weekend. We'll be back next week. See you later, everybody. Bye bye.